On Friday, March 9th, the 18th largest bank in America collapsed. Silicon Valley Bank was the second largest bank failure in United States history, only behind Washington Mutual in 2008. Long story short, there was a run on the bank. Almost $40 billion was attempted to be withdrawn all at the same time, and so all the assets were frozen, and eventually the government had to step in and take over. The bank stock crashed overnight, individuals and businesses freaked out, and everybody took to Twitter, causing a bigger panic and a huge run on the bank. Over the weekend, the Federal Deposit Insurance Corporation, or the FDIC, took over the bank, and the president has even come out and said everyone's deposits are going to be refunded. Everybody's going to be made whole, even beyond the standard $250,000 FDIC insurance that most banks carry. And shortly after that, on Friday, Signature Bank in New York was also taken over by the FDIC due to similar systemic risk, and they are also going to be reimbursing all depositors for money that they have in that bank. So with multiple bank failures, massive, insane headlines that are scaring the crap out of everybody, I've been getting a lot of questions from family, friends, viewers on, is my money safe in the bank? I've actually had friends text me and say, should I take my money out of the bank right now? What do I do right now? Is my money safe? Is my bank going to fail? What is going to happen with my money? But to answer this question accurately and honestly, we need to rewind all the way back to learn about how banking actually works, how the FDIC insurance policy works, what banks do with your money that you deposit, and if that bank collapses, how quickly can you access your funds? And if you stay to the end of the video, I'm going to show you a couple of banks that are doing the same type of investing and accounting that Silicon Valley Bank was. And we'll talk about if they're at risk of failure or not. So stay tuned to the end. Okay, before we go into the details of how banks work, I want to tell you a little more about why Silicon Valley Bank failed. In short, there was a lot of deposits that came in like 2020, 2021, but because of the pandemic, they didn't have a lot of loans going out. And that's how a bank makes money, is by loaning out money and collecting interest. So instead, they put that money into what's called a treasury. US treasuries are a safe investment. In fact, I just made a video about how safe those are here. But if you are a bank and you're using someone else's money that they might want back, you probably shouldn't lock it in a 10-year treasury. And that's what they did. Now, these 10-year treasuries were yielding about 1.5%, but we all know what the Fed did. They raised interest rates, and now that we're well above 3-4% and those treasuries are earning 5% or so, well, you locked in a 1.5% return here. Treasuries are paying 5% over here. Somebody's going to buy your treasury from you, they're going to pay a lot less. So now they had to sell these treasuries to cover the withdrawals from their bank. They're losing tons of money. And in fact, they had to write off a $2 billion loss. And then they tried to raise capital going, we're going to sell some more stock because we need to make up for that $2 billion loss. Well, as soon as the bank investors saw that, they freaked out. All the venture capitalists and startups that had millions and billions of dollars in that bank tried to withdraw all at the same time. And in fact, they tried to do over $42 billion in withdrawals like within days. And so eventually the bank said, we tried selling treasuries, we couldn't keep up with the withdrawal demand, we had to freeze assets, and then boom, the FDIC stepped in and took over. So that's how that bank run happened. And then the government stepped in and the White House says, we're going to cover not just the $250,000 insured deposits, we're going to cover all the deposits of the entire bank. So that's a really big deal for people because that gives them a little bit more reinsurance that even when there's a bank speculating and they made the wrong bet and they fully collapse, that the FDIC will come and take care of their insured money, and they might even take care of more than just their insured money. So let's talk a little bit more about what the FDIC is and how they protect your funds. Now, FDIC came about in 1933 as a response to the Great Depression. President Franklin D. Roosevelt put it into place to give people faith in American banks. When it first started out, it covered about $2,500 in deposits, and obviously with inflation, year over year, it is now covering up to $250,000 in deposits. And that is per depositor. So if you have an account open and your wife has an account open, you can each put $250,000 in there and it is fully protected. The FDIC is funded by those banks. They are paying for that insurance, and then it builds up a fund that then can pay back for people if there's a run on the bank, if a bank collapses, if there's some kind of issue. Your funds are protected. Now, FDIC insurance is so much more important these days because of something called fractional reserve banking. So here's the truth. It's not like the movies. The banks don't hold your money in a vault. And the banks aren't required to keep your money in reserve. In fact, because of fractional reserve banking, banks only typically need to keep about 10% of the deposits that go into their bank, and they can loan out the rest. That means 90% of the money that gets deposited to a bank is loaned out or invested elsewhere. So this fractional reserve banking system kind of sounds like a Ponzi scheme. Maybe it is a little bit, but it is at least a regulated Ponzi scheme. Now, a scary fact that most YouTubers won't talk about, and I don't see anybody saying anything about, but it scares the heck out of me, is in March of 2020, the Federal Reserve dropped the reserve requirements, and banks literally don't have to have any of their deposits kept in reserves. That means they can literally lend out or send out or invest every single dollar that gets deposited into their institution. Now, most smart banks obviously have some money on hand so that they can have day-to-day operational cash available, but the fact that they don't have to is scary. Now, banks are not a free place to protect your money. They are a for-profit business. These are publicly traded companies. These are some of the richest companies in the world, and they do that by taking your money, lending it out to other people, and collecting interest on that while paying you a fraction of a cent for every dollar you put in there. That is the banking model. Now, they also could take some of your money and invest it in safe investments like U.S. Treasuries. Now, there's something called duration risk that can come into play when they put too much money into a longer-term investment like a U.S. Treasury. They lose liquidity, which means they don't have money liquid to give out to people that need withdrawals. And the problem is, if enough people want to withdraw at the same time, they don't have enough in reserve, because this is fractional reserve banking, that a bank run can happen. And the other problem is, if they are making a bet, a long-term bet, especially on interest rates, well, a lot of banks have lost that bet because they put money into these long-term treasuries that have a low yield, and now yields are so much higher that nobody wants to buy these off of their hands, and so they're going to have to sell them at a discount, giving them huge losses on your money that you deposited. So that's how banking works. They take your money, they go make money with it, and hopefully when you need it, they'll give it back to you. But because of fractional reserve banking, they only need to keep a small percentage on hand, and in fact, legally, they don't have to keep anything. So what exactly happens if your bank does fail? If there is a run on the bank and they freeze withdrawals and you can't get access to your money? Well, as we saw in the bank failures of Signature Bank and Silicon Valley Bank, the government's been pretty quick about this, and I was actually very surprised. I was sitting back waiting to see how long is this going to take. So the FDIC is going to step in, take over the bank, and they will make depositors whole up to the insured amount. Currently, that is $250,000 per depositor. As we saw in these two bank failures, I think to prevent a panic, they're actually making all depositors whole, and especially Silicon Valley Bank, where I think it was over 90% of depositors had over $250,000 in these accounts, because they're covering payroll for hundreds of people. There's a lot more money in place. But the harsh reality is, if you have more than $250,000 deposited in a bank account, you are not insured, and you could lose access to that money if there's a run on the bank. So to recap, banks take your money, they can lend it out whenever they want, and they might make risky bets with U.S. Treasuries that lock your money away, and they end up realizing a bunch of losses. So that is what happens to your money in the bank. Luckily, your deposits are insured by the Federal Deposit Insurance Corporation up to $250,000 per depositor. So bottom line, if you have less than $250,000 in a bank account, you are safe. If you have more than $250,000 in a bank account, you are technically uninsured on the amount over $250,000. There is actually an NBA player that has, I think, almost 50 bank accounts open with $250,000 in each because he understands this. He knows that if his money's not insured, it's not protected and there could be an issue. So knowing all of that, and understanding that Silicon Valley Bank made these bets on U.S. Treasuries a very safe investment, but because of their long-term duration, they made the wrong bet and they went down in value, Are there other banks that are doing this? Unfortunately, there are. I mentioned I was going to show you some of the banks that are using similar accounting and investing principles that got Silicon Valley Bank in trouble. And this list is kind of shocking, to be honest, because there's some big names on here. Now, Seeking Alpha is an investing website, and they have a ton of newsletters and research on here. But I wanted to go to this because they have a list of banks where they went through the 10K forms from. So this is the end of last year. This is sort of the balance sheet data, and they're looking at something called Accumulated Other Comprehensive Income, or AOCI here. Basically, it's unrealized losses. I told you they were holding those 10+ year like mortgage-backed securities in U.S. Treasuries, and those were a low rate. And then basically those went down in value. So for whatever they bought them for, they're going to sell them for less. So those treasuries are now worth a lot less. And on the balance sheet, it's looked at as an unrealized loss. And unrealized loss just means they haven't sold it yet. They haven't realized the sale of that asset. But if they need to raise cash quickly, they're going to have to sell those at a loss. And now they have these reported losses, which are going to drop the stock price, which is going to make their unrealized losses as a percentage of their stock price very, very high, which spooks a lot of investors. So again, you can go through this. I'll put a link to it below, but check this out. So Citigroup, for example, has a loss per share of about 33% of their entire stock price. Now, these acronyms here are basically treasuries or investments they have available for sale that are at a loss. So it looks like they have about $256 billion in cost. That's what they paid for the investment. But the investment's only worth $249 billion now. So that is almost a $6 billion loss of things they're looking to sell. So they're going to realize these losses. So Citigroup is seeing that. JP Morgan Chase, much bigger bank, but they have $216 billion cost and a $205 billion current value. So a little over a $10 billion loss. Again, this is just on the available for sale. HTM is just one of those things that they're going to hold. They're going to do the 10-year hold. They call it hold to maturity of that investment. But if you look at the total between these two, you're seeing $31 billion unrealized losses, $47 billion unrealized loss, right? A high percentage of that current stock price for that bank. Signature Bank, this one did fail. As you can see, huge percentage of their stock price was in losses. They had a total loss of about $3.3 billion, and that was a high percentage of the value of their stock price. So U.S. Bank, First Republic Bank, this is another one that's in trouble here, and Wells Fargo has $50 billion in unrealized losses. So again, a lot of these banks are playing the same game. They just didn't have a concentration of high net worth depositors like Silicon Valley Bank, who all wanted their money at once, right? These huge startup companies with big payrolls, they're like, nope, I need my billions of dollars right now. Now, it doesn't mean there couldn't be a run on some of these banks here, but I just wanted to show you there's a ton of these banks. All these big names are playing the exact same game. Now, the question is, are these banks going to fail? And I think the answer to that is no. Most likely, most of these banks won't fail. I'll say the small to medium-sized banks have a chance of failure if they have a high concentration of high net worth individuals or large depositors that realize that their bank, if you look at their public records, they're going to go, oh, hey, they made the same bet that Silicon Valley Bank did. Those ones are at a risk of failure, but a majority of these very, very large banks, they have a very wide variety of different types of depositors. So I don't think they're going to have, everybody withdrawing all of their money at the same time. It have to be so many more people, not just this small concentration of high net worth people. So even though a lot of these banks are playing the same games, your money is protected by the FDIC. And if you're one of these larger banks, there is truly a thing called too big to fail. And that happened in 2008 where the government did bail out banks. And they just showed it even on these medium-sized banks like Silicon Valley Bank and Signature Bank. They're going to make you whole even if you're not fully insured. So the bottom line is the U.S. government is not going to let the banking system fail. And if you have less than $250,000 deposited, you're fully insured. And if you have more than $250,000 deposited at one of these institutions, you're still probably going to be made whole within a couple of days because the government does not want to cause a panic. You are protected by the full faith of the U.S. government. All right. This video is very interesting, not something I normally make, but if you find this helpful, if you want me to do more current news stories or my take on how to approach investing or handling your money or debt payoff or any of those things within the current news environment or what's going on in the financial world, drop a comment below. I'd love to hear from you. And if you think your money is not safe, I would love to hear your reasoning why. Put a comment below and let me know how you think your money might be protected better than in a U.S. bank. All right. Thanks for watching this video. I appreciate you. And until next time, peace.